welcome to the Capital Discussions round or market analysis. I'm Tom Nunamaker with Bill Ghauri and Jerry Furst. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. Actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that disclaimer that basically you're responsible for your trading out of the way, we can, we were talking about this chart of the VIX before we started the recording. One thing I found interesting is if you look at the VIX futures, July, August, September, they're still in contango, but just barely. And you can see that on this chart that because I plotted for the next three futures contracts. You can see there's some separation in here and here and here, but here they all kind of collapsed together as the VIX went up. So it's not going to take much for it to get where these short-term VIX futures are more expensive than the farther out ones. And that goes into backwardation, which is kind of an indication that there's some fear in the market.
Tom, are you sharing your screen? Because I don't see your screen.
Oh, you don't see my screen?
No.
Well, let me reshare it then. Thought I was sharing it. You know, I did. I think I did. I hit stop sharing, so sorry about that.
Oh, okay.
Okay, so you can see it now, I take it.
Yeah, okay.
Okay, sorry about that. So here you can see the next three futures plotted along with the VIX, and there's some nice space between them, but as you get, like today, there's hardly any. And you can see here 17.3, 17.3, 17.6. So if we went to VIX Central, we would see it's kind of flat. It's not quite in backwardation yet, but it's getting pretty close. And, you know, to me, that tells me the market's got a little bit of fear starting to get baked into it.
Yeah, I would think so.
And then I don't know if my screen was being shared when we had this, but here's the VIX chart for the last year, and that last 3-4 months you're talking about in the 12 to kind of 16, 17 range, and we've clearly just jumped way above it. So this is definite breakout territory.
Oh, yeah, yeah. And see, over the last 3 months, I mean, we've actually had some really nice trading because a number of times we've gotten down into that around that 12 area, which, you know, for me, low volatility means I want to get long Vega. So I'm looking to, generally, what I like to do is when it gets around 12, well, just for the benefit of the listeners who may not know how I trade the SPX. And I generally trade, I sell naked puts, but I sell naked puts when we've had a nice vol pop. But then when we have a nice decrease in vol, usually around, I mean, for the last 3 months or so, when vol has gotten down around that, you know, roughly 12 area, I've been buying an at-the-money put debit spread, so I get a little long Vega. So I kind of play that ebb and flow of the volatility going up and down. So when it pops up and it's been up in that 14, 15 range, I'm selling some, you know, puts, and then when it drops down to around 12, I'm, you know, buying. You know, I'm getting some long Vega by buying an at-the-money put debit spread. So that's been working good for about the last 3 months, but then just as we were talking before you started the recording, with today, to me, I see this as a breakout to the upside. So I'm kind of viewing this as a step up in volatility now, whereas we were pretty range bound for about 3 months. I see now us breaking out of that range, and so we'll see what we get. As far as my positions go, I actually closed out all my positions today. They were profitable, and so I went ahead and took the profits, and just going to sit tight for a while now to see what goes, you know, with the whole you know, Greece EU crisis, because clearly it's affecting the markets. And so I think it's a good time to be out of the market.
Yep, that's not bad advice. If you do
As you've said, Tom, cash is a position.
Great. Now, I just pulled up a two-day chart of the euro-U.S. dollar. So this, the last trading day was Friday, so this is Friday's close. And then we had all the talk breakdowns over the weekend, and everybody panicked, opened up about 200 pips lower, which is a pretty big move down. And then the happy juice was flowing, and everybody's happy, and actually closed up. Let's see, what are we now? Up about 80 pips. So kind of crazy movement considering what's going on with the euro. I don't think people really know where it's going to go.
Yeah.
Here's a daily chart. Look how big that candle is. This is crazy.
Yeah, that's a big outside bar. Outside bars, it really does show you the uncertainty there. As you know, a lot of times you'll see inside bars, which can typically, actually, inside bars will show a pause in the movement. So whatever direction it's been going, if you see an inside bar, often that means a pause. Just basically a pause in the movement. But when you see an outside bar, in this case, it was, a reversal bar. It had been coming down, and then you had a reversal bar. That could mean that. Well, it's always hard to say, but that could mean that there was some, some of that fear has actually kind of subsided, and it's now actually closed above and the previous bar. Which makes it an outside bar. So it's kind of interesting, given everything that's going on. I kind of wouldn't have expected that.
Well, I think the two words "capital controls" made the euro kind of crash this morning, but then. The only two things on the horizon really are the debt that they're probably going to default on the payment tomorrow, and then the next thing is they kind of push the ball, kick the rock down the road, or kick the can down the road till Sunday to do a referendum to see if the Greeks want to accept more euros and a bailout in exchange for more austerity. And from what I've heard, what I've seen in the news, that they're kind of polling, I think they're going to vote yes, that they want the money. So I don't think they're going to leave the euro and have to go back to the drachma, but, time will tell. But I don't think a lot's going to happen after tomorrow until that referendum happens. So my guess is the U.S. markets might sell off a little bit more follow through, but, everybody kind of wants to see what's going to happen with Greece.
Yeah, I expect that is there's still a lot more volatility to be played out here before we really know what's going on.
Yeah, here's the SPX, so you can definitely see that's a strong push down. That the knives are falling, so don't try and catch them, right?
One of the things that I look at is, I watch the ES, the futures market. While I trade the SPX, I watch the futures market, and mainly because I can see volume, and volume is something that I like to look at. But one thing that is kind of interesting is that today's volume that we had was pretty significant, and basically it's the highest volume that we've had. Oh gosh, I think the last time we had this kind of volume was back around March 18, when we had a nice big push up. Although that wasn't, it didn't continue for much more, and it had dropped back there in March. But today's volume is pretty significant, and so this. Although what's interesting is on the ES is that it closed right above its 200-day moving average. So, and the 200-day moving average is still sloping up. So actually, in my book, we're still in a confirmed uptrend. Of course, my view of uptrends is probably a little more longer-term view than I think most traders. But you look at the 200, it's still sloping up nicely, and price actually closed above it. So, and I'm looking at the ES. So we'll see what we get.
This is a 3-month chart of ES. And you can see the volume, 2.25 million today. It's up there.
Oh yeah, absolutely. Can you throw a 200-day moving average on there?
I can figure out how do I do that. Let's see. How do I do this? I don't really change these charts much.
200 actually today closed around just around 250, or I mean 2050.
Okay, here's moving average. See if I can figure out what it is. Edit indicator. Here he is, 200. See if this works.
What the hell?
Maybe not. Maybe if
Yeah.
up to a year or something. Well, it's not getting it. Do you, Jerry, are you back? I don't know if Jerry's back yet. Bill, do you have a chart with the ES with the 200 day?
Yeah, I do. If you want, I can pull that up.
And pass it over to you.
All right. Let me find the thing here. Oh, okay, I got it. So let's see. Tell me again how I do this. Do I just click the ball?
No, there should be a share screen button. You can also go Control Alt and then the letter D like Delta.
Okay, Control Alt D. That's how I've done it before. Okay, so let me pull up my screen. Make sure I got the right one.
I see something loading.
Oh, I got the wrong screen. Hold on. Let me... How do I change screens here?
Can you just drag the chart over?
Yeah, I can do that. Sure. Let me move it over here. It's on my other monitor. Okay. All right. Does that, do you see?
Yep.
Okay.
That's it.
So, so here we are. The 200-day moving average. I use a green dashed line. And actually, if I zoom out here a little bit, let's just get about here. You can see we've been in a nice confirmed uptrend here. We tested the 200 back here. The other moving averages that I use is a 20 simple moving average, which is this yellow line, and a 50-day moving average, which is this blue or sort of turquoise line. And so those are the ones that I use. But anyhow, one of the things that I look for is I look at the slope of the 200-day moving average, because that to me is a good indicator of, you know, whether or not we're in a confirmed uptrend. So not only just looking at the price, whether it's above it or below it, but I also look at that slope. Now that's probably, I take a little bit longer view, I think, than some people, but the SPX puts that I sell, I usually sell those between 40 and 65 days to expiration. That's my preferred DTE window. And so that I have found through numerous back testing that works out pretty good. It's kind of a nice sweet spot. But just to kind of zoom in here on my, I had sold some SPX puts here. And I hedged it a little bit before the FOMC announcement. We rallied up. I sold some call credit spreads here. And I actually tried to sell some additional put debit spreads here when VIX, yeah, actually, let me pull down. Let me see. Let me do a few things here. When the VIX got down around here, around 12, I was actually trying to buy some at-the-money put debit spreads. I didn't get filled on those. I think I was being a little too aggressive when I was trying to sell those. But in any event, I closed out all my positions here because, and by the way, that's what I'm pointing to here is the intraday chart for the VIX, and I saw at this point here that we were kind of stepping up in volatility, and so I was profitable on my positions, and so I decided to go ahead and take the profits and close things out and just kind of sit tight for now. But if I kind of, let's see, can I, Let me do this. I don't know why this thing goes back to, if I kind of zoom out here a little bit, you can see actually, let me clean this up a little bit. Well, oops. You can see here actually what happened was that here is actually when I sold my puts. I hedged the position here. We had FOMC here, didn't do too much, rallied up a bit, and then this is where I sold my calls. So the one thing that is probably worth mentioning is that if you watch price and volatility, and in this case here we had a nice pop up in volatility, and we had a nice gap down here in the ES. If you get in at a good price, and then either hedge or sell some hedge with an at the money put debit spread, or possibly sell some call credit spreads or naked calls, when you kind of play this ebb and flow of the volatility, then you can actually weather some pretty healthy movements to the downside. So in the case, for example, here I ended up buying back one of my puts, still made a profit on it, and then when it was kind of clear that things were moving, the volatility was really climbing here, I closed it out here. So I actually made money on both of the puts that I sold, as well as the call credit spread, and even made a little bit on the put debit spread. So I like to play that use technical analysis and play the volatility back and forth. But here you can see that this is, I've annotated here, I've had this line in here, this price level of 12 for several months now, as well as this one at 15. And so I've been just playing it back and forth between 12 and 15 for several months. But you can see here now we've broken out of that range. Here we closed it over 19. So now I'm going to have a new range to look at. But it's clearly it's not a non-directional approach. I mean, this type of trading is clearly directional trading. But you can, if you watch things closely, you can kind of stack the odds in your favor.
Well, and you're taking advantage of the option time decay too, with a little directional bias. So, yeah, it's not a bad way to trade at all.
And the nice thing about it is that you don't have to be 100% correct, and you can still make money. A lot of directional traders, if you're not using options, then you're basically either long or short. There's no in between. But as most of us know who trade options, is that you can put on a trade that's, completely balanced in terms of deltas, for example, and not take any directional bias whatsoever, which is how I think most option traders do trade. And that works out fine, but you can kind of, juice it a bit if you do watch price and volatility, and then kind of start legging into these positions. So when it's a good time to be selling premium, you sell premium, you get short Vega. And then when it's, you got a nice drop in the vol, like for example, the VIX getting around 12 or something like that, then it's a good time to get long Vega, and you may want to buy a little premium, and you can do that, for example, just buying at the money put debit spreads. And the nice thing about doing at the money put debit spreads is that, as most option traders know, the decay curves for options that are at the money decay much slower than those that are further out of the money. So when you're selling puts or put credit spreads, and those shorts are out of the money, with a delta of, 20 or 15 or even 10 or something like that, they're going to decay slower than the hedge that you have closer in. And in fact, I think it was my July position I had on, I ended up keeping that hedge on for, I think the hedge was on for about a month, and I hardly lost anything on that hedge. Of course, the put credit spreads, and the naked puts, those decayed because the deltas of those were much further out. But if you have something that's closer to the money, it decays a lot slower. So it really works out good to hedge with an at the money put debit spread, but buy it when it's cheap, and then sell your put premium when volatility has popped. And so that's kind of the basics of this style of trading.
And Bhaskar has what ratio hedge at the money debit?
Very good question. What I typically like to do is if we refer to the upper profit zone, let's use Jim's terminology of that being Jim's Jeep terminology, that being the roof, and then the lower profit zone being the hood. I like to have the hood maybe about 2 to 3 times that of the I'm sorry, have the roof about 2 to 3 times that of the hood. So maybe 2 to 3 times. If you look at the expiration graph, that is. That's how I do that. And that I find it works pretty good. But the key is that you want to be buying your hedge when volatility is low. I mean, you want to buy it at a good price. So if you put the hedge on, in fact, I used to trade pretty much the broken wing condor, but I'd put it on pretty much at the same time, the hedge and the puts. Now, what I found was that I was timing things pretty good in terms of getting good premium for the puts that I was selling, or the put credit spreads that I was selling. But then I was, at that same time, I'm paying a healthy price for that hedge. And I realized, at the end of the day, I was making good money on the put credit spreads, but the decay that I was experiencing on the hedge was, it was pretty significant, even though it was at the money. So I sort of determined that it's better to sort of leg into these positions to sort of play that price movement and volatility movement. I call it the ebb and flow of price and volatility. And then you can actually do much better than just being a straight, non-directional, boom, everything on all at once.
Hey, Jerry, are you back?
Yes, I am. Can you hear me?
We can hear you.
Huh?
So I don't know how much of that you caught, Jerry. Did you just come in, or have you been here in the background?
I only saw like 3 seconds of it. I just got back to my headset here. So,
okay, well, we've kind of gone over the VIX and SPX, but it'd be interesting to get your take on things if I want to give you the ball.
Here, I'll go ahead.
Very good.
I'll stop sharing here. Yeah, there you go. And you can...
Is that Bill?
Yeah. Hi, Jerry. How are you?
Very good, Bill. I hope things are good by you, and looking forward to this volatility. I know I've seen you. I assume you enjoy the volatility in options.
I do.
Yeah.
I like it when it goes up and down.
Exactly. I had my best, probably my best ever trading run during the summer of 2011. As we were getting downgraded, and
I remember that period well.
Yeah. So we'll go ahead and we'll get started here. Thank you, Bill and Tom, for picking up the slack for a momentary issue. So today is June 29th, Monday. It's 5:01 p.m. Equity markets are closed. And good morning, good afternoon, good evening, everybody. My name is Jerry Furst. And here on Capital Discussions, joining in the discussion of the week ahead. And as I've been talking now since, well, this is June, for the past 7 months and going on 4 or 5 years, it looks like Greece is actually now, falling apart. That's obvious to anybody paying attention. the interesting thing is that I'm watching the news, as I'm sure a lot of you are, and I'm just amazed by the, what's the right way to put it politically correct, Tom? Is Jim in the house?
No, Jim's not here.
Okay, so I can feel free to talk freely. So basically, it's kind of like the propaganda. It's just amazing how I see some of the same old people, Wilbur Ross, Mario Gabelli, all of these people come out of the woodwork and they say, everything's fine, nothing to worry about. It's kind of like, you don't need to sell yet. Wait until we get done selling what we have to you guys, and then you can panic. So it's pretty much kind of like last night before I got to sleep, I'm watching Tyler Durden and his postings, pseudonym for who knows who. But, taking a look at the fact that the bank holiday would last until at least July 6th is interesting. And that look at all the locals who've had plenty of time in Greece to figure out that this could have been coming, and now they're shocked that they can only get 60 euros out of the ATM machine. So this is what it looked like last night at about 8:19 Eastern Time. This is my 3x3 grid on the markets. So we have the euro in the top left with the pound and then the dollar yen. Then over here on the center row, the dollar index, oil, and gold. And then we got the S&P, the Dow 30, and the NASDAQ on the bottom. And so I used to love trading the currency markets. Formerly, I was known as First on Forex, broadcasting on FX Street for about 4 or 5 years. And so the opening gap is always an interesting thing on the currencies, because typically you wouldn't see too much action, except in times like this. Sundays are always, Sunday evenings are always the time to know that there's some volatility that's not just normal, run-of-the-mill, nothing to worry about stuff. So take a look at the correlations. It's a 5-minute chart here. Notice that the euro gapped down, the dollar index gapped up, and the S&P 500 gapped down. Of course, the Dow and the NASDAQ did the same as far as being equities. Notice that gold gapped up. That's not too surprising because the headlines are that now the Greeks are looking for gold coins. And I've always been telling people who ask me about my opinion on gold is if they want to take possession of currency, you really got to break out a spectrometer. And if you go and get collectible coins that are sealed by PCGS or NCS, how do you really know what's inside the plastic? So the other option, of course, is jewelry. So some people might say, come on, that's scare tactics. Well, is it scare tactics if you had a bank account in Greece, and you don't know when, if ever, the bank is going to open up again? And, oh, that'll never happen here. Well, it sure did in the past. So just because, everybody says to remain calm, the idea is, is this volatility for real? Or is it just another blip, Or is it going to be, as I started talking in the beginning of the year in January, when the Swiss National Bank pulled the peg from the Swiss dollar to the, or the Swiss krona to the euro, I was saying that was a potential ripple effect, saying that it could have been like a Bear Stearns moment where it takes about 6 months for the ripple effects to go through all the margin calls and all of the derivatives that have to, and all the trades that have to be unwound. And so that's something to look at. So I'm looking for correlations. So this is what it looked like at 8 o'clock this morning Eastern Time before the equity markets opened. And you can see that those gaps were pretty much filled. And that's what I was talking to some people last night, past midnight. I was talking to some traders saying I was expecting that potentially the gap on the S&P could get filled in the morning, and we were heading in that direction at 8 o'clock Eastern Time. The euro did, in fact, close the gap and, in fact, ended up positive. But let's go ahead and look at a live chart, take a look where we're at right now. You can see that the euro, this is on a 1-hour chart. Well, let's just leave it on the 1-hour chart here. So you can see the gap down last night on the open, and then closing the gap and closing up from Friday's close, which is kind of like, isn't it counterintuitive? Wouldn't you think the euro would be getting completely sold off? So in these times of high volatility, a lot of times I liken it to plucking a string on a guitar or something like that, piano wire might be more appropriate as far as the harmonics. And so the first pluck of the string, it's going to have to work itself out if it's true, volatility. But Angela Merkel didn't look too happy. I don't know, Tom, if you were paying attention to the locals, how if the locals are restless because they could be stuck with the bill.
Yeah, I mean, my wife's Dutch and listens to much as the Dutch news, and like she was saying, there was a Belgian reporter that used the ATM in Greece, and he get as much euros as he wanted out of the ATM. So it was just the Greeks who couldn't get money out of their own Greek bank. But there's I guess people here kind of assume Greece isn't going to pay their debts, but they're not sure if they're going to stay in the EU or not. I guess it all depends on Sunday how they vote on that referendum.
Yeah, exactly. That's a big part of it. My comment there is that the Europeans have a lot more history and a lot more recent history as far as what's happened when the markets crash. But as far as the referendum in Greece, it's interesting. I was reading one article about that where they said, okay, so they're going to let the Greek grandmothers vote on whether or not to stay in the European Union or not, and expect people like that. If the average person who's a talking head or writing financial articles can barely figure out what's going on, how are they going to expect the average Greek to understand the true complexities of what they're voting for? It's really sovereignty. Are they going to be Greek, or are they going to be citizens of this new construct called the European Union? It's very similar to what's happening here in the United States, where just last week the Supreme Court has now ruled that the word state really means federal government. And that's really the bottom line of the Supreme Court decision last week on Obamacare. And so all of this does have huge implications because, Greece, their stock market's closed for 6 days at least a week. And, that's one of the great things I love about options. A little quick quiz for everybody. What's the best strategy off the top of your head to do in the situation if the markets are going to be, if we have a stock market, options market closure? Anybody want to, what would be, well, keep out is one, okay. Buy delta, okay. I haven't seen that, those are definitely options. How about selling the short term? Because if the market's closed, you're guaranteed theta. You're guaranteed theta. So anyway, that's just one way to look at it. The correlations that I'm looking at since the U.S. session has basically shut down now for the day on the equity and options markets, you can clearly see the correlation here where the euro went up and closed the gap and actually closed high. You can see the dollar index go down and the equity indexes dropping on the S&P, the Dow, and the NASDAQ. Gold is bewildering to me. We've kind of got a flag pattern on gold. If I've got a separate tab here just on gold alone, and you can see here on a 30-minute chart, earlier in the day we had this gap up with a zigzag down, which is a bullish flag pattern. I would have expected it to get up to somewhere around 1190, close to 1190 or higher. But somehow or another, the price of the metals are staying relatively stable. Selling premium is undefined, way risky in that situation, Stephen writes. Well, everything is risky for sure. Is it undefined? Not necessarily. I'll show you the IWM in a couple of minutes. And so the only other thing I wanted to really look at is the fact that oil dropping. Now, the interesting thing, if you take a look at the calendar also for the week ahead, as we're looking at June 30th coming up tomorrow, what are some of the other issues that are supposed to get resolved June 30th? Yeah, exactly. Why is oil dropping? Exactly. Why is oil dropping? Why is gold going sideways? Those are good questions that anybody want to share their suspicions as to why oil would drop. The issue about June 30th is that there's supposed to be a hard and firm deadline as far as the Iran negotiations, and everybody is kind of whistling past the graveyard saying, well, whatever, and I guess maybe there'll be some kind of an agreement and something will happen, but I never hear anybody talk about what happens if there is no agreement. Okay, a little audience participation. Okay, if the Iranians basically say, we're not going to talk to you, we're done playing your game, goodbye. We're not signing nothing, we're not agreeing to nothing. No agreement, no way, no how. What is the option? Then we're no worse or better off than prior to talks. Okay, well, from what and Stephen, thank you for chiming in there, anybody else? From what I remember, it seems like, okay, so if there are no agreements, so then what's on the table? And there's a lot of other geopolitical issues coming up. So the only other thing that I wanted to share is that last night I'm looking at this that comes up out of the blue, and I've noticed that it is getting proper attention now. But really, I remember reading about this here and there over the last few months, maybe 6 months, even a year. There's been talk about Puerto Rico, but $72 billion in debts that's going to go ahead and get wiped out or backed up by somebody. It's amazing that we're talking about billions and people shrug their shoulders. What's a few billion here and there? So it is interesting how a lot of these things can converge all at one point into a perfect storm, and then all of a sudden, while everybody's paying attention to the chaos, there's a lot of other weird stuff going on, such as in 2008, while everything was melting down, all of a sudden a whole bunch of banks disappeared overnight, and within a couple of days, Washington Mutual was now, I don't know, was it Citibank, and all these other little banks got shut down and reopened, and too big to fail, just got even bigger. So having said that, we can start looking more closely at the charts as far as what we've got as possibilities. So Stephen's right. This is why central planning ultimately does not work. They can't control adverse convergence. Yeah, I like it. Adverse convergence. Very good. Uh, and here comes the concept in a way that a lot of people think that all of these central planners, they know exactly what to do and how to do it. Some of them are pretty smart. Some of them have a plan. But then all of a sudden, once the stuff is flying and some of it hits the wall and they're loading more into the catapult to send some more flying, you know, things get messy. So that's where we're at. Let's take a quick look at the calendar for the week ahead. Monday's already done. Farm prices, real quick, consumer confidence. Tomorrow on Wednesday, you got the PMI, manufacturing index, construction spending, and then Thursday we've got regular old jobless claims, factory orders, and then the bonds. It's interesting. The bond market just keeps on going.
Another interesting thing about this week is because the markets are closed Friday, options are expiring a day earlier. And I know Tony Sizemore and I were talking earlier today, and he couldn't figure out why it said in IB that his options were expiring, his SPX options on Wednesday, because they're settling Thursday morning. So if you're trading those weekly options that settle normally on Friday morning, they're going to be settling on Thursday morning this week.
It's a great point. That's a great point. And I hope everybody's got on their calendars all of these bank holidays and so forth. Banks are open, but they can definitely give you a little bit of an edge. And it's amazing with the weekly options now that you do start to see that weekly volatility in the beginning. And Tuesday always seem to show a little bit more volatility than some of the other days. Depends on if you're trading individual stocks or the futures indexes. But all right. So yeah, good comment on that, Tom. Got an electrical storm moving in. Hopefully you're not going to lose power here. I'm sorry, go ahead.
Oh, yeah, I just thought it was good for people to remember that because it's an unusual week.
Yep, absolutely. So I'll go ahead and I'll bring up IWM. So here's the Russell. Here's one chart where I was watching and looking looking at any of the decent little pullbacks that we've had for the last few years. And we've got a decent stretch. We're not overdue, but I'd say that it's about time for a pullback. Obviously, a support level here on this chart, 123.50 and 121.50. That's on a weekly chart. The 50-period moving average comes up right on this 123.50 range. So for anybody who has been trading through these high volatility events and moments, nothing moves in a straight line. And so you could have these morning gaps down 600 to maybe even 1,000 points now. I mean, we're at 18,000 on the Dow, right? So a 1,000-point move in the morning, followed by a 1,000-point or even 2,000-point reversal, going up 1,000, and then closing the day flat isn't out of the question. If you've traded through those markets before, you know. Johnny Lunchpail comes home and the market's unchanged, and meanwhile you've been on the biggest roller coaster ride of the market. So, so I'm looking at a support level kind of right around here's interim, 121, we'll call it. I mean, we got a good, easy, solid tap of the 123.50 range. But if we wanted to get some juice out of this, 121.50. So for you option view fans, I'll just run you through the trade finder option. And so I'll go ahead and hit my assets, go ahead and update the file. I was talking to tech support last week, and they were saying to always update the asset file going into trade finder. I'm in back trader mode. I was on hold before, so that might not even matter. Targets, we're going to say 121.50. And of course, the disclaimer is that this is strictly for educational purposes only. And I'm going to say let's do this for 30 days. Let's take a quick look at the vol chart. You guys were looking at the VIX when I wasn't watching, and I'll make the assumption. Well, here, let's pull up the VIX real quick for a second. So there's a nice gap. Yeah. Notice these spikes. Usually once you have one leg up on these spikes, take a look at past history, past patterns. Once you have one gap up, it's usually followed by at least a couple more. And that's a nice move. So I would expect another higher move probably tomorrow. Implied volatility is still relatively low, right? Options are still cheap. So let's go ahead and we'll use a simple $1,000 as a goal. I want to make sure. Yeah, we'll keep it simple. And let's just see what the 121.50 gives us. So as a best case return, got a 43% gain, $480 with 1,000 at risk. All right, so look at what it picked out. The January 2017 123 put. Okay, so I take a quick look there. Let me just look at the top. They're all about the same. 122, here's a 129 at $16. Obviously, we've got some good premium to sell going way out. I'm surprised it's not. Why are they all picking out these leaps? Okay, here's some Julys. I mean, those are long term. Let me see what happens without the leaps. Okay, did I not uncheck that? let me clear it and go again. Okay. So Len Yates. Okay, so if I uncheck including leaps, why am I getting the January 2017s? All right. I think there was a new update. So we've got the July week 5 127s, the August 127 puts. Okay, but there's not much money in that, right? So let's go ahead and look at some of the spreads. Let's look at the diagonals, verticals, the back spreads, and if we're going to go long, might as well look at the butterflies. And let's make an expectation of implied volatility increasing another 10%. Let's just clear all that and go up again. All right, it's looking a little better. You got to love these 100% probabilities of profit here. Let's take a look at that one. Just by buying the January 138 calls. What is going on? Okay, what am I doing wrong, guys? I've been using option view for a long time. And sometimes you just gotta you just got to chuckle. It's like how their probability of profit comes out to 100%. I'm saying give me 30 days, 120, 150 with a 10% increase in vol. And there's another suggestion that I asked for, but they don't give it to me. It's like, let me limit the max number of contracts. They've done a really good job on the filters, but I just want to add one more. Just, if I don't want to make my broker too happy, let me limit it to, let's say, 90 or less. As far as number of contracts. How many of you guys are not following me, or how many of you are lost, or how many of you are following along with what I'm doing here? Just to recap, as my i7 processor is grinding through, I am looking at IWM, ETF on the Russell, looking at a support level of about 120, 150, and I'm saying within 30 days we should touch it. And I'm looking for Trade Finder to give me some ideas. And some of these are just ridiculous. I should get another filter that says, don't show me anything with 100% probability of profit. All right. Excuse me. Well, we got some good lightning storm coming through South Florida here. Go ahead, Tom.
Oh, I was just going to say we're coming up on an hour, so maybe think about wrapping it up pretty soon.
Yeah, sorry about that. I picked probably too many. Let's just look at this. All right, we've got way too many picks. Let me just clear and close that. And so, all right, well, if we're coming up on an hour, I guess I ran out of time. Sorry about not getting in earlier on the call, but I had a minor, actually kind of a critical issue to take care of on the home front. And so, yeah. But in the meantime, I want to wish you all the best within the volatility here. Play it safe, and good trading to everybody, because you don't know what's around the corner.
Yep, and also to Bill for joining us, and your inputs as well, Bill. So thanks everyone for joining, and but just watch your deltas and your gammas this week, because we could see some more volatility.
All right, thanks, Tom. Thanks, Bill, for helping out. Okay.
You bet. Bye-bye.